A lot of people think that insurance is a scam until they actually need it. What would happen if you lost your ability to work or someone in your family passed away? What would you do? Welcome to Demystify, where we bring clarity to everyday financial decisions. Today, we're going to be talking about insurance. Insurance isn't necessarily preparing for when something bad happens, but it's making sure that you're adequately protected so that you can still achieve your goals and dreams if something does happen. Insurance is a financial protection tool. It is not about making money. It's ensuring that in the event of a tragedy, that your family and your assets will be taken care of and protected. Let's start with the type of insurance that protects the engine of your financial life, your income. A lot of this is going to be dealing with protection, but in particular, there are two types of insurance that primarily serve the purpose of income protection. And what we're going to be talking about first is life insurance. If someone depends on your income, you likely need coverage in this area. This could be used to pay off debt, provide childcare, protect future income, and build your financial future. Even a stay-at-home spouse or stay-at-home parent might need coverage as well. I think oftentimes when people think about life insurance, they think of it as only a tool for those that are working. And what I like to explain to my clients often is that just because you're not working doesn't mean there is not some financial value that would be lost if you were to pass away. Specifically looking at that stay-at-home parent, for example, just because they're not bringing in a paycheck, if they were to pass away, that parent is likely the one that's going to be taking care of the kids, taking care of the house. And if they weren't there, there would now be a new cost associated with those activities that weren't there before. Typically, that stay-at-home parent might not need as much coverage as the one that is earning the income, but coverage is still necessary in those situations. Let's talk about the different ways in which you can calculate your insurance need. First, you can take a look at the income replacement method. This is a very generic, simple calculation where you can take a 10 to 15 times multiple of your annual income, and that would be your insurance need. This gives you a very simple starting point where if you don't want to do detailed calculations, it's a good jumping off point and a good rule of thumb. Option number 2 is going with the needs-based approach. This is taking a look at any outstanding debt, future costs of childcare, if you have other financial goals such as education for children, funding weddings, helping with home purchases. This is really categorizing your future needs and calculating what they might be from an insurance standpoint. Insurance needs are personal. It is not a one-size-fits-all approach. You're going to need to factor in how many kids you have, your age, how much longer you're going to be working, what debts you have lurking out there. Just because you know someone has an X amount of dollars in coverage, that doesn't mean it fits you as well, and it needs to be personalized to fit your needs. The amount of insurance that you need is not based on the amount that your coworker has. It's about the financial hole that will be left in your absence. So let's talk about the different types of life insurance that are out there. We'll start with term insurance first. This is the most pure form of insurance, if you will. Basically what this is, it's providing you a certain death benefit, let's say $1 million, for example, for a certain number of years. 30 years, for example. It's very pure and it's designed as purely a way to protect future income and provide a certain benefit. From an affordability standpoint, term insurance is going to be the cheapest of the major options because eventually the coverage will end and it will go away. This is a great tool for young families, income protection, and debt protection in the future. Whole life insurance is also another type of insurance that you have. It's going to be a permanent policy that will build a cash value, but it's going to cost more. Some people look at this as a way of wealth creation, which it certainly can be, but just know it is out there. Universal life insurance is also a different type of insurance that is out there. It is going to be more expensive than term, could be comparable to a whole life policy, but is going to provide a little bit more flexibility and may have an underlying investment component to it. With these permanent type of policies, sometimes you can either get a fixed rate or fixed growth rate on the investment component of it, or with a universal policy, for example, it could be a variable rate that is tied to an underlying asset. Let's talk a little bit about private policies versus employer-sponsored programs. Oftentimes, employers will offer life insurance as a benefit to their employees. Sometimes you'll see they'll provide you a base benefit. Let's say 1 or 2 times salary might be the standard, and the employer covers that for you. Oftentimes, if they're offering that life insurance, you'll also have the ability to buy up additional coverage, typically in the form of a multiple of your salary. So what are the positives associated with employer-sponsored coverage? One, it's going to be much easier to set up than a private policy might be. Oftentimes, there is no underwriting required depending on the amount that you get, and it can be cheaper. What are some of the downsides associated with that employer sponsored coverage? Well, for starters, it's typically not portable, meaning that if you leave employment, you lose your coverage. Oftentimes, too, as you age, it actually might be cheaper to get a policy on the outside than it is through your employer sponsored coverage. And that's because of how they calculate the cost of employer sponsored coverage. When you're using that type of plan, it's going to be group coverage and it is a pooled group of individuals. All they are looking at when determining how much your coverage is they're looking at your gender, smoker, non-smoker, and your age. So that is all they are looking at. Oftentimes you will find that as you grow older, the coverage gets more expensive and you actually might be able to get it cheaper on the outside if you're a healthy individual. Because if you're a healthy individual on the outside, you may be able to get a cheaper policy due to your health because you're not being pooled with all those other people. Oftentimes with life insurance in particular, you'll find that the younger you are, the less expensive your coverages are. So particularly if you're starting a young family, have income to protect, that could be the time to get this type of policy because it is going to be a relatively inexpensive benefit that'll protect you for the time that you need. Another benefit that you might see available to you through work, or you could go privately with, is life insurance on your children. Now, I'm certainly not saying this is something that everyone needs, but what I recommend people consider with life insurance on their children are a few factors. One, this could be a way to provide funeral expenses for a child. Another one of the possible outcomes for life insurance on your child is if they have student loan debt lurking out there. In particular, private student loan debt. Those loans do not go away if they pass away. So if you are a cosigner on your children's loans or they have private loans, you may want to consider coverage in the loan amount that they have, just in case they were to pass away. This certainly isn't a topic that people like to talk about as you're dealing with death and it's a very touchy subject, but ultimately it's a way to prepare for the worst case scenario. Moving on to disability insurance. Life insurance and disability insurance both provide the same rationale behind them. It's a protection of your income, just for different reasons. Life insurance is if you pass away. Disability insurance is if you can no longer work. Your income is likely your largest asset, and your income is your most powerful financial tool. So disability insurance is a direct protection over your income. Disability insurance is similar to life insurance from the standpoint of you usually have two options. You can either go with your employer-sponsored coverage or you can get an outside policy. Let's first talk about employer-sponsored coverages. Typically, they might offer you some sort of base coverage that they pay for, maybe 50 to 60% of your salary. Oftentimes, you'll have the ability to buy up additional coverage up to 70 or 75% of your salary. One thing to keep in mind here when you're dealing with employer-sponsored coverage is similarly to life insurance, it's typically not portable. So if you are no longer working for that employer, you no longer have coverage. Another thing to note is that typically your disability insurance through your employer only covers salary. Oftentimes, it will have written in the document that it does not cover bonuses or commissions. So if you are a person that has a lot of your income driven by commissions or bonuses, it could make sense to go with an outside policy to supplement your employer coverage. Oftentimes, too, when you're buying up additional coverage, let's say your employer provides you 50%, but you want to buy up to an additional 70% of your income. What you'll have the ability to do is either use pre-tax dollars or after-tax dollars. I know the gut reaction that people has is to use the pre-tax dollars. They want to get a tax deduction for whatever they're buying up. What I oftentimes will caution people is against that. Because if you use after-tax dollars as opposed to pre-tax dollars, that portion of your benefit that you buy up will actually be tax-free to you. On that note, sometimes employers will provide you the option to pay the tax on the premiums that they are paying for you. And typically you'll see this on your paycheck in the form of imputed income. What is that doing for you? That is ensuring that the entire benefit that you would receive would actually be income tax free to you because you are already paying the taxes on the employer-sponsored premium and any additional buy-up that you are electing. You're already taking a reduction of your income at this point. You're already going to be at 50, 60, or 70% of what your total income was before. Do you want to have to pay taxes on top of it too? Two disability policies with the exact same income benefit could provide two different results depending on how you chose to pay the taxes on it or not. I want to touch a little bit on property and casualty insurance. Specifically, I'm talking about homeowners and auto insurance. Oftentimes in the financial planning realm, this is not something that is discussed that often just because most advisors don't take a look at it. One thing to consider with your property and casualty insurance is that it is another form of protection for you. It is not always the best practice to just go with the minimum state mandated coverages because at the end of the day, this is the coverage that is protecting your assets in the event that someone goes after you in the form of a lawsuit. Oftentimes, people will just look for the cheapest option, and I really caution against that, especially if you have assets that need to be protected. Unfortunately, in the world we live in today, we live in a very litigious society, and it is not uncommon that people try to sue if there's a slip and fall at your house, if you get an automobile accident. So it is important to review your coverages and ensure that the amount of coverage that you have is actually protecting you in the event of catastrophe. Insurance limits should really reflect what you have to lose, not just the state minimums. Another form of coverage that people can look to add to their existing property and casualty insurance is an umbrella policy. An umbrella policy aims to protect above and beyond what is already covered in the form of your home and auto insurance. For example, someone could buy a $1 million umbrella policy that would protect in the event of a lawsuit that exceeded their original coverages. It's important to note that these are generally relatively inexpensive, but you have to have certain minimums already on your home and auto to be able to qualify. And if you don't have those met, you'll have to up your coverage to that before you can get that umbrella policy. So what are some of the mistakes that people make? Sometimes people assume that their coverage to work is enough. You really want to review the coverages that you have and make sure that in the event of loss of life or disability that you would actually be okay. Some people will outright ignore disability coverage altogether. It is much more likely that you become disabled than actually pass away, and it's an insurance that people will avoid. With that, it is a little bit more expensive than your life insurance would be, just because it's more likely that it would happen. Another mistake that people make that we just touched on is going with the lowest cost option with your home and auto. You want to make sure that your coverages actually line up with the assets that you're trying to protect. The goal isn't to buy every insurance policy that's out there. It's to ensure that your family and assets are protected in the event of catastrophe. Insurance is one of those things that you hope you never need, but you want to make sure that when the time comes, if you do have that event, that it is required that you have enough coverage. It's not a way to build wealth. It's a way to protect the assets that you have worked so hard to build. Thank you for joining me today. I really appreciate it. If you could like and subscribe, that would mean the world to me. Have a great day.